Back to the explainer. Today we're tackling a really fundamental piece of SAP materials management, automatic account determination. It sounds complicated, but we're going to break it down. So let's just start with the big question. Picture a massive global company. Millions of things are happening every single day. Inventory moving, goods being received, products shipping out. How on earth does a system like SAP know exactly which financial account to post to every single time without a human touching it? Well, the secret sauce, if you will, is something called automatic account determination. You can think of it as the brain, or maybe the central nervous system, for all financial postings in SAP. It's the logic that makes sure every transaction lands in the perfect spot, and we're about to see exactly how it's configured. Okay, so before we get into configuring the how, we first have to understand the what. We need to lay down the financial blueprint, because everything we're about to do is built on top of two absolutely essential building blocks. First up is the chart of accounts. Now, what you're seeing here is the formal SAP definition, but basically it's the master list of every single general ledger or GL account that your company uses. It defines all the account numbers, what they're called, and what they're for. So to put it even more simply, just think of it as the company's financial dictionary. Every possible financial transaction or bucket you can think of, it has a name and a number, and it lives right here in the chart of accounts. Our second building block is the valuation area. This one is all about the where. It answers the question, at what level in our company do we want to track the value of our inventory? Are we looking at it from a super high level, like the entire company? Or do we need to get way more specific and track value at each individual factory or warehouse? This setting determines that. And this brings us to what is, honestly, one of the first, most critical decisions you have to make when setting up a system. It's a choice you make at the very beginning, and it has huge consequences for every single inventory transaction that will ever happen in the system. You've got two paths you can take. You can set your valuation at the company code level, which is simpler and gives you a uniform set of accounting rules for all the plants under that company, or you can go with the plant level, which gives you way more granular control, letting you have different accounting rules for each specific plant. And here's the kicker. You have to make this decision before a single material is even created. No pressure, right? So, to really see how this all connects, we're going to walk through a real-world example. And for this explainer, we're going to focus on that first option. We're going to say our valuation level is set at the company code. All right, let's make this real. Theory is one thing, but seeing it in action is what really makes it click. So we're going to build out a sample company structure, piece by piece, so we can really understand the problem we're trying to solve. So here is our setup. We've got a multinational company with 4 subsidiaries, and in SAP, those are our company codes. Now, I want you to notice something really important. 3 of these companies, the German, the US, and the Canadian ones, all share the exact same chart of accounts, YCOA. Only the UK subsidiary is different. And boom, right there, that creates a challenge for us. If Germany, the US, and Canada are all using the same financial dictionary, that same YCOA chart of accounts, how in the world can we set up different accounting rules for them? What if, say, US regulations are different from German ones? Well, luckily, SAP has a very clever, but actually very simple tool designed for this exact problem. It's called the Valuation Group Encode, and it's what's going to give us the flexibility we desperately need here. And the best way to see how powerful this is to do a little before and after comparison. We'll look at what happens when this feature is turned off, and then we'll see the difference when we flip the switch and activate it. Okay, so in scenario 1, with this code deactivated, the system is basically blind to the differences between those 3 companies. Because they all share the YCOA chart of accounts, the system just lumps them together. The consequence? No flexibility. You're stuck with one set of accounting rules for all 3. But now let's activate it. The entire idea, and you can see it right here in the documentation, is to use a simple code to tell the system, hey, I want you to treat these specific companies as a single group for accounting, and these other companies as a different group. And this is where the magic happens. Watch this. For step 1, we just assign a code, let's call it 0002, to our US and Canadian company codes. That's it. In step 2, we've now created a brand new specific group just for our North American companies. And the result? Now the US and Canada are treated identically to each other, but they are treated separately from the German company, even though all 3 are still using the exact same chart of accounts. We've just unlocked the ability to have different accounting rules. So that's the how. It's a pretty elegant solution, right? But let's take a step back and really hammer home the why. Why is this considered one of the most fundamental, foundational settings in all of materials management? At the end of the day, it all comes down to this. These settings control how potentially billions of dollars in inventory value get recorded on a company's financial books. Your initial choice of valuation level sets the whole stage. And this little valuation grouping code provides the critical flexibility you need. Getting this right from the very beginning is absolutely crucial for accurate financial reporting. And that leaves us with one final thought. You now know the technical how of using this grouping code, but the real skill comes in knowing the why. So, put yourself in the consultant's shoes. What business reasons, things like different tax laws, or unique industry reporting standards, or even just internal management preferences, would lead you to group certain companies together, but keep others separate? Answering that question is when you really start to master the system. All right, let's talk